Welcome to the Deep Dive. Today we're plunging into a topic that, well, for decades, has really been seen as the unshakable cornerstone of global finance. I'm talking about the mighty U.S. dollar. For so long, it's been, the ultimate safe haven, the go-to currency, no matter what seemed to be happening. But here's the surprising thing that's kind of shaking things up right now. For the first time in quite a few years, we're actually seeing U.S. stocks, bonds, and the dollar all declining together. And this isn't just some minor blip. It feels like a pretty significant, almost unprecedented signal, maybe, of a real shift in investor confidence.
It truly is. This trifecta of weakness, as some are calling it, is a really rare occurrence. And it definitely signals a kind of reevaluation of the dollar's traditional confidence premium.
That premium. Explain that a bit.
Well, that premium was built up over decades, really, based on perceived U.S. stability, its strong institutions, unparalleled liquidity, So when investors start questioning that, even slightly, it's not just about a few percentage points on the currency's change. It suggests a more fundamental shift in how global capital views safety and return. And that could potentially raise borrowing costs for the U.S., impact trade flows globally. It's got big ripples.
Exactly. So in this deep dive, our mission really is to cut through all the noise around these developments. We're going to try and explore the complex kind of interconnected forces at play behind the dollar's recent weakening, and maybe even more surprisingly, the rise of other currencies that seems to be happening alongside it. We'll unpack everything from, central bank policies and fiscal challenges to these evolving global dynamics that are fundamentally reshaping the whole currency landscape. Our goal is to help you understand not just what is happening, but crucially, why it matters. Why it matters for the future of global markets and, for your own financial understanding. So let's set the stage a bit with the dramatic recent movements we've actually seen. The dollar has shown some really sharp depreciation lately, dropping to its lowest level against the euro and sterling since, way back in 2021?
That's right. A significant move.
Yeah, and it hit a 3.5-year low against those major currencies just recently in June 2025. And if we look at the dollar index, the DXY, that's the one measuring the dollar against a basket of major currencies. It fell to 99 back in April 2025. Now compare that to its recent highs. It was at 107 in October 2023.
Right.
And almost 110 in January 2025.
Huge difference.
So as you mentioned, this isn't just a minor blip, is it? The dollar shed nearly 8% from its cyclical peak in a relatively short time.
That's a very significant drop, yeah. And it's crucial to understand why this is happening now because, this isn't just about relative interest rate yields anymore, which was traditionally the main story.
Right. Higher rates usually means stronger currency.
Exactly. While those interest rate differentials definitely influenced things in the past, higher rates attracting capital, strengthening the currency, what we're seeing now is different. Sentiment and overall capital flows seem to be playing increasingly significant roles, maybe even dominant roles. Investors are now looking beyond just the numbers on interest rates. They're weighing a much broader set of factors.
Okay, let's unpack this then. If it's not just the interest rate story, what's really behind this significant shift? Because it feels like a lot of things are hitting at once, putting this pressure on the dollar.
You're absolutely right. It's multifaceted.
Yeah.
One key concern that comes up in our sources is the perceived erosion of the Federal Reserve's independence.
Ah, the Fed's independence. Okay.
For instance, there have been discussions about political pressure. We saw criticisms from then-President Trump aimed directly at Fed Chair Jerome Powell.
I remember that, calling him terrible.
Exactly. And talk about his replacement. There's even this notion mentioned of a shadow Fed chair potentially undermining Powell's influence.
Shadow Fed chair. What does that mean exactly?
Well, it's this theory suggesting that, external political forces might be unofficially impacting the Fed's policy decisions behind the scenes. And that could become really problematic if inflation were to pick up again, right?
Yeah.
Because it might lead to the Fed maybe discounting inflation or not tackling it aggressively enough.
I see. Political interference concerns.
Precisely. And then there's the Fed's expanded role. It's moved into areas beyond its traditional core mandate, like climate policy. That blurring of focus has also invited further politicization, some argue. And all this, it directly threatens the dollar's safe haven status, which is really built on the idea that U.S. institutions are impartial and strong.
That's a really fascinating point about the Fed's independence. Makes you wonder how much external pressure can really sway such a critical institution. But connecting this to the bigger picture, you mentioned other pressures. What about the U.S. fiscal situation? We hear so much about the debt. Why is it a particular worry for the dollar now?
That's definitely another major factor. The U.S. fiscal health is, well, undeniably worsening quite significantly. We're seeing these widening budget deficits, and the interest costs on the national debt are rising rapidly.
Right.
To give you an idea, one source mentioned a proposed $2.4 trillion tax bill. That alone is estimated to add nearly $1.8 trillion to the deficit within just 5 years.
Wow, $1.8 trillion in 5 years from one bill.
Yeah. And this scale of borrowing, it compels investors to demand higher term premia.
Okay, the term premium, remind us what that is.
It's basically the extra return investors demand for holding longer-term bonds compared to short-term ones. It compensates them for the increased risk over time, risk of future inflation, or higher interest rates down the line. So this demand for higher returns keeps those long-term yields elevated, and that puts persistent downward pressure on the dollar, as investors might start looking for more attractive or less risky alternatives elsewhere.
So it sounds like maybe eroding trust in institutions plus this growing debt. That's creating some serious headwinds for the dollar's traditional strengths. But what about policy uncertainty? Are global events or specific U.S. policies also feeding this unease among investors?
Oh, absolutely. Policy uncertainty is a big one. Think about things like trade policies. Our sources mentioned the Trump administration's July 9 deadline for tariff negotiations. That kind of uncertainty weighs heavily on business investment, on exports. It dampens economic activity.
Right. Businesses hate uncertainty.
Exactly. But perhaps even more impactful recently is the increasing use of financial sanctions and other dollar-based enforcement tools. For example, the freezing of Russia's foreign exchange reserves back in 2022. Or there was mention of a tweet in 2025 threatening sanctions on Colombia's dollar assets. Actions like these, they erode the perception of the U.S. dollar as being, neutral ground.
Neutral ground, meaning impartial.
Yeah, an impartial medium for global transactions. When countries start perceiving that their dollar assets could be, weaponized against them, it makes them question whether their access to the dollar system is truly guaranteed. And naturally, that leads them to seek alternatives, to diversify.
That's a really powerful point about the weaponization of the dollar. It definitely changes the calculation for countries holding huge dollar reserves. Now, what's fascinating here is this shifting investor sentiment you mentioned and the portfolio rebalancing that follows. You brought up this trifecta of weakness earlier. U.S. stocks, bonds, and the dollar all selling off together. What are the broader implications of that?
Well, this trifecta of weakness, where all three major U.S. asset classes decline simultaneously, it's rare, as I said, and it's quite a concerning signal. It suggests that capital might be fleeing the U.S., not just shifting between asset classes, but as an overall investment destination.
Like investors are losing faith in the whole U.S. market picture.
Potentially, yes. Or at least reevaluating the risk. Think of it like major global investors who usually see the U.S. as the ultimate safe harbor. Now they're starting to maybe pull up their anchors a bit and look for new ports. We've actually seen data showing foreign investors pulling back from U.S. stocks, record weekly outflows mentioned in some reports. While interestingly, inflows into European equities seem to be on the rise.
So money moving out of the U.S. and into Europe.
It appears so. And notably, these investors are apparently even reducing the currency hedging on the remaining U.S. equity exposures, which means they're less protected from dollar fluctuations. Why? Possibly because they anticipate further dollar weakness, or they just don't see the same need for that U.S. exposure anymore.
Wow. Okay, so that leads into another factor mentioned. Dollar overvaluation. Is the idea that the dollar was just too strong for too long and now it's correcting?
That seems to be the final crucial factor, yes. Many sources point to the dollar's long-standing overvaluation finally beginning to unwind. For years, the dollar has traded at levels maybe higher than what the underlying economic fundamentals might suggest, purely based on its safe haven status, perhaps.
Right.
Predictions are now circulating for a potential, say, 10% to 20% decline against major peers like the euro and the Japanese yen over the medium term. JP Morgan, for instance, was cited forecasting euro-USD at 1.29 and USD-JPY down to 114. So that's over a very long 10-15-year horizon.
1.29 for the euro. That's a big move from where we are now.
It is. But this is often described not necessarily as a breakdown of the dollar's global role, but more as a significant reset. A reset of its value to levels that are more aligned with fundamentals, perhaps. Less about a collapse, more about a market correction to a more sustainable valuation.
Okay, that makes sense. A reset, not a breakdown.
So with the dollar facing all these pressures, it really begs the question, are other currencies actually stepping up? Are they filling the void, or are they facing their own issues? Because here's where it gets really interesting. while the dollar faces these, considerable headwinds, other currencies aren't just holding steady. Some are actively making gains.
That's absolutely right. And the euro, for example, has been particularly strong lately. It topped $1.17 recently, hitting a 4-month high. That's its highest level against the dollar since September 2021.
Wow.
And it's gained a solid 5% against the U.S. dollar since what some sources call Liberation Day back on April 2nd, 2025.
Liberation Day, what was that?
Apparently, it refers to the date of a significant policy announcement or maybe a market event that really sparked a strong rally for the euro. The sources didn't specify exactly what, but this strength seems driven by factors like, increasing Eurozone stability, pretty strong exports, and these growing expectations of German fiscal stimulus finally coming through.
Even with the ECB cutting rates. Yeah, that's the interesting part. Despite the European Central Bank cutting rates 7 consecutive times, inflation in the Eurozone is now near its 2% target. And the labor market there is remarkably robust, so that combination seems to be maintaining investor confidence. However, it's worth noting, some analysts do argue the euro might be getting a bit stretched now, maybe detached from fundamentals, suggesting the rally could be overdone.
Okay, so a strong euro, but maybe watch out for a pullback. What about other major global currencies? Are we seeing similar strength elsewhere against the dollar?
Yes, definitely. Beyond the euro, we are seeing other noteworthy shifts. The Japanese yen, for instance, surged pretty significantly. That was mainly due to Japan finally introducing new positive interest rate policies, moving away from years and years of negative rates.
Big policy shift in Japan.
Huge. And sterling, the British pound, and the Swiss franc also hit multi-year highs against the dollar recently. Sterling, in particular, got a boost from stronger-than-expected UK inflation data, and that reduced the prospects for aggressive rate cuts from the Bank of England. And the Canadian dollar, too, has seen significant appreciation. That seems buoyed by rising oil prices, this general U.S. dollar aversion we're seeing, and also signals from Ottawa. Their latest throne speech apparently signaled a transformative shift toward reindustrialization in Canada, which investors seem to like.
Interesting. So it really feels like a broader recalibration happening across the board, not just a dollar weakness story in isolation. And you hear so much talk these days about de-dollarization in the news. How much of a factor is that in this current environment? Is it real?
That's a really critical piece of this puzzle, yeah. We're definitely observing a broader trend that gets called de-dollarization. Now, this isn't necessarily about completely abandoning the dollar overnight. That's unlikely. It's more about diversification.
Right. Not putting all eggs in one basket.
Precisely. Countries like Russia, China, India, Turkey, they're actively increasing their gold reserves. And that's partly driven by these concerns we discussed about the U.S. potentially weaponizing the dollar through sanctions. Now, while the Chinese yuan's internationalization is still somewhat limited by its relatively closed capital account, its share in global FX reserves is gradually increasing, albeit slowly. But these efforts, they clearly indicate a conscious move by central banks around the world to diversify away from an over-reliance on the dollar.
So, okay, we've covered a lot of ground today. Fed independence, fiscal deficits, policy risks, de-dollarization. But maybe we can step back for a second. How do all these intricate economic forces actually translate into currency movements on the ground? It can feel a bit abstract.
It is complex, definitely. But understanding the underlying mechanics helps connect the dots. So traditionally, as we touched on earlier, short-term interest rate differentials were really the primary driver. Higher rates in country A meant capital flowed in, strengthening currency A. Simple enough. However, with the onset of what we call unconventional monetary policies, think quantitative easing, QE.
Bond buying by central banks?
Exactly. Like QE1 by the U.S. Fed back in 2008 after the financial crisis, or the ECB's big asset purchase program starting around 2015. With these policies, the term premium became a much more predominant factor in driving currencies.
Okay, the term premium again. So central bank actions directly influence that.
Yes. When central banks like the ECB started buying massive amounts of long-term bonds, they effectively compressed this term premium. They artificially lowered those long-term borrowing costs. And that prompted investors, seeking better returns, to rebalance their portfolios. They moved money out of those low-yielding domestic assets and into higher-yielding foreign assets. And that outflow of capital leads to downward pressure on the domestic currency. So ECB buying bonds could weaken the euro.
Okay, that makes sense. So it's not just about the immediate short-term rates anymore, but about how central banks are managing the long-term outlook and risk premia. But are there other sort of non-monetary factors that also play a significant role, things besides rates and QE?
Oh, absolutely. It's definitely not just Interest rates or central bank policies, other variables play a significant role, and sometimes they create unexpected currency dynamics. For instance, consider relative stock market performance.
Okay.
Paradoxically, sometimes when European equities, say, outperform U.S. equities, it can actually lead to the euro depreciating against the dollar.
Wait, good stock performance weakens the currency. How does that work?
It sounds counterintuitive, right? But think about large institutional investors. As they rebalance their global portfolios to capture those nice European stock market gains, they also often move to reduce their foreign exchange risk exposure. So they sell the foreign currency, in this case, the euro associated with those gains.
Ah, locking in the stock gains but hedging the currency risk by selling euros. I see.
Exactly. Then there's domestic sovereign credit risk, an increase in perceived credit risk in the euro area. For example, like worries about a government potentially defaulting. That tends to weaken the euro against the dollar. It reinforces the dollar's traditional safe haven role during times of stress, as investors flee that perceived risk back towards the dollar.
Okay, so risk off means dollar up, typically.
Typically, yes. We also see relative long-term inflation expectations playing a part. If long-term inflation is expected to be higher in the euro area compared to the U.S., that can also lead to euro depreciation over time. That's in line with the old purchasing power parity theory, which suggests exchange rates should eventually adjust so goods cost roughly the same everywhere.
Right, inflation erodes purchasing power.
Precisely. And one more, oil prices. There seems to be a positive correlation between Brent crude oil prices and the USD exchange rate.
Higher oil, stronger euro.
Well, one possible explanation is that oil-producing countries, who get paid mostly in dollars, often recycle those revenues into reserve assets. Some of those reserves might be held in euros, but a lot goes back into dollar assets. So higher oil prices mean more dollar flows globally, which can influence the dollar's value against other currencies, including the euro, sometimes strengthening it if flows go out of the dollar. It's complex. But the point is, these non-monetary factors, when you layer them on top of interest rates and QE, they really add significant depth to our understanding of why currencies move the way they do.
We've certainly navigated a truly complex landscape of global currencies today. Wow. From, the changing role of central banks to these geopolitical pressures and shifting investor sentiment, it's really clear the dollar's role is evolving. Maybe not collapsing, as you said, but certainly undergoing a significant reset. It feels like the foundational pillars that have supported King Dollar for so long are definitely facing some unprecedented scrutiny.
That's really the key takeaway, I think. Despite all these shifts we've discussed and the growing diversification efforts by central banks and global investors, the U.S. dollar still overwhelmingly dominates global finance. Let's be clear about that. It's involved in almost 90% of all FX transactions, accounts for something like 50% of trade invoicing globally, 42% of SWIFT payments. It remains incredibly entrenched in the system.
Right, it's not disappearing overnight.
Not at all. However, this deep dive has certainly shown that King Dollar, as it's often called, is facing scrutiny like never before. And the trends we've talked about, from U.S. fiscal health concerns to these de-dollarization efforts, they are undeniably significant. They absolutely warrant close attention going forward.
So here's a final thought to leave you with. As global investors continue to reassess their exposure to the dollar, and as central banks keep navigating this really tricky world of inflation, geopolitical tensions, and policy uncertainty, how might the balance of power among the world's major currencies continue to shift in the coming years? And perhaps more intriguingly, what unexpected alternatives might emerge, maybe even challenge the status quo in the decades to come?